Hi, I'm Ross from Coomsmith Property Accountants. Obviously, National have just put through their proposed tax changes through today, and there's two major things that we're looking at property investors. One is the two-year brightline, which I'll talk about second, and the first is the interest limitation changes. So every property investor was hoping that they were going to change the rules for existing properties, and they would basically reverse the interest limitation rules. So if you had an existing rental property, you could keep claiming 100% of the interest with no problems. Unfortunately, that hasn't come true, but it's probably in between. It's probably better than I was expecting. I was expecting it to get reversed in 2026 or 2027. So yeah, potentially a little bit better than that. And yeah, so what they've done is if it's existing rental property with no exemption, the interest deductions 31st of March 23, the year ending 31st of March 23, there'll be no change. It would be 75% deductible. The current tax year that we're in, from the 1st of April 23 through to the 31st of March 24, there's going to be no change and stay at 50% deductible. With higher interest rates, that's actually not going to be too bad for a lot of taxpayers. Potentially, the interest rates doubled over the last couple of years, so going down to 50% deductibility is not going to change your profit too much, and it's not, or your taxable profit too much, and not going to change the tax. The problem is that a lot of taxpayers are now losing cash flow and potentially still have a tax bill. The first change, the year ending 31st of March 25, National's got it staying at 50%, whereas Labor was down to 25. Year ending 31st of March 26, increased to 75% interest deductibility, where Labor have zero. 31st of March 27, increased to 100%, Labor had it zero. So yeah, definitely a benefit there for property investors, and definitely will get more interest deductions if you have existing properties. And it's also going to take away some of the benefit of buying a new build. Obviously, we hear it in the marketplace all the time. Buy a new build so you get interest deductions. Well, this is going to change a little bit, but existing properties, you're still going to have a real pain point. The next 2 or 3 years, higher interest rates, still going to have limitations on your interest claims. So yeah, be very careful of your cash flow over the next 2 or 3 years. If you've got a new build, you're not affected by those interest limitation rules, but your cash flow is still going to be terrible for the next 2 or 3 years. So make sure you watch out for that. Second point that came out was two-year brightline. Personally, I don't like two-year brightline. What happens is people will buy a property, say they buy a section, they'll build a house on it, they'll wait the 2 years, then they'll sell it. It'll be outside the two-year brightline, they will pay no tax on it. And yeah, there'll be lots of speculators like that who buy a property, it jumps up in value, they'll sell it. If it's outside two-year brightline, yeah, they'll claim it as a capital gain, not pay tax on it. To me, that is not fair. I'm a trader and a holder. So anything that I trade, I buy something, I do it up or subdivide it, I sell it, I pay my GST and pay my tax. To me, that is fair. Anything I long-term hold, I'm tainted by my trading. So I keep it for 10 years or more, then it's a capital gain. So I have a key two parts. I'm a trader, pay tax, pay GST, or I'm a holder, 10 years or more and don't. To me, that is the two things. And if they bring in the 2 years, what happens is it goes back to the intention test. IRD really struggle to enforce this, and it's really hard to them to prove what was your intention. So a lot of people who are speculating end up paying no tax. And then what happens is the governments look at it and go, there's all these speculators getting away with it, not declaring their income, not paying the tax they should, and bang, Brightline comes in, and then bang, interest limitation comes in. All these bad rules have come in because of property investors are tainted by property speculators. So to me, 2 year just too short. What's going to happen is so many people are going to get around the rules, get away with not paying tax on what they really should, and then that's going to bring in some worse rules. These rules have been pretty bad, but yeah, the next governments will come up with something worse to catch us. So to me, I'd much rather traders, speculators get caught, pay their tax, pay their GST. It can still be a good business if you do it right. And long-term holds should be at least 5 years. You should hold it long-term. And then that clearly separates it. And yeah, to me, me, too short a bright line is actually just going to hurt property investors long term. So hopefully you've enjoyed that, and yeah, we'll look forward to seeing what comes up. Obviously, after the election, National could be joining with ACT, Labor could still be getting in, lots of possibilities, or there could be a huge amount of debt the government has. Our deficit could be a whole lot more than expected, so the rules might change again. So we'll watch this space, but yeah, for the moment, definitely good to have some clarity on what National is proposing. Thanks a lot. Bye.